Japan is currently grappling with a formidable challenge in stabilizing its currency, the yen, which has been on a downward trajectory against the US dollar. This struggle is evidenced by Japan's substantial expenditure of over $60 billion from its foreign exchange reserves in 2022 alone to defend the yen, marking the country's first intervention since 1998, when the exchange rate plummeted to nearly 146 yen to the dollar. Despite these efforts, recent trends indicate a continued depreciation of the yen, reaching a 34-year low of 160 yen to the dollar in April. This persistent decline over the past 3 years, punctuated by interventions by the Bank of Japan, underscores the formidable challenge Japan faces in stabilizing its currency. The BOJ's interventions to bolster the yen's value have yielded mixed results, with preliminary data suggesting that the central bank may have spent upwards of $30 billion in a recent effort to strengthen the exchange rate. However, the yen's value remains low, prompting speculation and concern among currency traders and investors alike. A significant factor contributing to the yen's weakness is the widening gap in interest rates between Japan and other major economies. While Japan's benchmark interest rate has seen a slight increase to a range of between -0.1% to 0.1%, interest rates in the US, UK, and Eurozone have surged by at least 4.5 percentage points since 2022. This interest rate differential has incentivized investors to seek higher returns outside of Japan, exacerbating the yen's depreciation. Furthermore, Japan's inflation outlook remains uncertain, despite headline inflation exceeding the BOJ's 2% target for nearly 2 years. There are indications that price increases have been slowing, reflecting ongoing challenges in breaking free from deflationary pressures that have plagued Japan since the collapse of asset prices in the 1990s. The impact of the weak yen extends across various sectors of Japan's economy. The substantial depreciation of the yen has led to a significant increase in the prices of imported goods, rising by a staggering 64% since 2020. This surge in import costs has particularly affected industries reliant on imported fuel, translating into higher energy expenses for businesses and households. Additionally, while the weak yen may theoretically make domestically produced goods more competitive on the global market, Japanese exporters face challenges due to their extensive operations in international markets where currency fluctuations can significantly impact competitiveness. The implications of the weak yen vary across different sectors of Japan's economy. On one hand, the tourism industry may experience a boost as a depreciated yen makes holidaying in Japan more affordable for international travelers. This is evidenced by a notable increase in tourist arrivals, with February seeing an 89% rise compared to the same month last year and a 7% increase from pre-pandemic levels in 2019. However, the weak yen is unpopular among Japanese consumers, who grapple with higher prices due to increased import costs. This sentiment is shared by policymakers and central bankers, who are wary of rapid currency fluctuations and are reluctant to cede influence over monetary policy to speculators. Despite the BOJ's interventions and policy adjustments, the future outlook for Japan's currency remains uncertain. The central bank's recent interest rate hike in March is viewed as a modest adjustment rather than the beginning of a series of rate increases. Consequently, the prevailing sentiment suggests a continuation of yen weakness or significant and potentially futile spending to combat it. In conclusion, Japan's struggle to rescue its plummeting currency underscores the intricate challenges facing its economy, including interest rate differentials, inflation uncertainties, and global market dynamics. These factors collectively contribute to the complexity and persistence of Japan's currency dilemma, with no immediate or straightforward solutions apparent on the horizon.